Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Tariff discussions dominated last week's news cycle, certainly with market uncertainty pretty high. Major US and Canadian indices have been down to start the week, with the Dow off 200 points over the course of the last little while, with some citing potential recession fears. We heard some of those gathering steam last week and then even over the weekend. So what might it all mean for investors? Joining us here today to unpack some of the macro themes on his radar and put a lot of the pieces of noise that we are hearing into context and what they might mean for you is Fidelity Director of Global Macro, Jurrien Timmer. Welcome, Jurrien. Phew, are we glad to see you here? Welcome back.
I've got a new acronym for you. Fidelity is famous for its acronyms, and the STNR is the new one. It's the signal to noise ratio, because that's been a full-time job, just trying to figure out what the hell is going on and what are the things we're supposed to be focusing on versus the noise. And it's been a full-time job.
An absolute full time, and it already is your full time. So I can imagine it's only adding an extra piece to it. Investors are worried about losing their gains, right? I mean, this is sort of, you watch the market, you listen to all the noise, and you think, holy smokes, there it goes. So just give us a sense of what we've seen and maybe where we can calm down just a bit here.
Yes, and you're in Canada, you're not alone, because here in the US, we have the same thing. And of course, we're dealing with both advisors as well as the end investor, and there's millions of them. And I always know what I need to focus on in my Sunday report, because I hear from the people in the field saying my phone's ringing off the hook. Customers are worried about obviously losing their gain. So if we go to slide one, I did this study many years ago, but I trot it out whenever this happens, and it shows where the S&P prior to this morning's decline was down 8% from its high, the Mag 7 down 19, the Russell 2000 down 18, which is very interesting that the Magnificent Seven, the mega caps, and the Russell 2000, the small caps, are down the same amount, whereas the S&P equal weighted is down 7%. So it's like a barbell. I've never seen that before. It's really interesting. But so in the shadings, you see the drawdowns. You can see, obviously, we've had some monster ones, but in the table is what I want you to look at. The odds of a 5% drawdown is like half the time. The odds of a 10% drawdown is like 37%, right? So the math is, or the value proposition for investing in stocks, is that you get these really nice returns over the long run, 10, 11%, but the price to be paid for those returns, right? There's no free lunch anywhere. So you're paying a price for those returns, and that price is occasional volatility and occasional corrections and drawdowns. And the difference between, whether you can withstand those drawdowns or not is the difference between someone who is compounding returns and someone who is getting whipsawed by the market. And obviously, we want to be in the former camp. Having said that, of course, it's up to all of us to construct a portfolio with the help of everyone watching that maximizes risk-adjusted returns, that achieves your goals while also letting you sleep most nights. And that is the trick. But after you've done that, and it's not that difficult to do that because it's math, but after you've done that, the hard part comes in, which is not to freak out when the market goes against you, because the market goes up 60, 70% of the time, which means it goes down 30 to 40% of the time, which is a lot, right? So there's not a small chance that the market is not doing what we want it to do at any given time. And then we need to have that discipline to not make emotional reactions. And this is, of course, where all the folks watching come in, because they are holding the hands of their customers at times like these. And hopefully what we're doing here every Monday kind of helps give them a little bit of confidence that the world is not about to end. And of course, these moments are opportunities to rebalance, right? Whenever you have a volatility event, and I don't even know if I would describe it yet. Certainly there's volatility in the headlines, but the markets, I don't know if they're quite volatile yet. But these are opportunities to sit down with your advisor, or if your advisor with your client, and say, are you where you want to be? Like, is, and to rebalance if that's necessary. And certainly there's been a lot of things moving around, right? So in terms of the US versus the non-US, and certainly kudos to my colleagues here who run the target date operation that really were holding on to their guns, saying, we believe in this mean reversion trade between the US and global. And they were very much a minority voice, and they held on. And boy, is it paying dividends at this point, because if we go to slide 5, I can just show you for the S&P again. This is a daily chart, but you see the Mag 7 relative performance in the purple, and the ex-US, so the ACWI ex-US in the orange, and you see that those jaws, going wide open and then shutting. So the mean reversion is fast and furious, and it can be, right? And so it's a really tricky thing, because if you're too early, you're sitting there waiting for months for something to happen, and you're losing money, because being early is the same as being wrong. And then when it happens so fast you can't even react to it. And this is really one of the tricky things about active investing.
So it's fascinating. And is it also the same? Let's, you're talking about Europe. Let's maybe further that, but also talk about EM, China as well. It had some massive moves actually in the fall that almost no one was ready for.
Yeah.
But is it time in a way to get ready for EM? Or as you say, things can move so quickly that if you're not there in advance, it's hard to sort of
Yeah,
guess.
that there's so much to unpack. But so clearly, what happened? We had the election; it was decisive, and the Trump trade playbook, for the lack of a better term, was that okay? Animal spirits in the U.S., tariffs, they probably won't happen because they're a bluff tactic, and of course, we know better
Can you just
now.
repeat that for all of, yeah, what now?
Um, I think that the general
Robin?
belief in the market following the election was, okay, the glass is half full, right? We're going to get deregulation, extended tax cuts, animal spirits are going to come back. And yes, the tariffs are a problem, but they're probably only for a negotiating tactic. And so we're gonna assume that that goes away, and all the good stuff stays, right? So it was
Yeah.
strong dollar, higher yields, strong US exceptionalism, and that lasted for about 3 weeks. The S&P 500 equal weighted index peaked in November. I've got slide 9. And the Mag 7 peaked in December, so very shortly after the election. So here's the Mag 7, kind of in no man's land right now. We're holding those old lows. But look at the Mag 7 on slide 6. And so that thesis was widely subscribed to right away. And of course, Bitcoin was part of that, right? Bitcoin went to 109,000. And now we get the strategic reserve, and Bitcoin's trading at 80,000. Like, it could just go, you know, buy the rumor, sell the news is a cliche, but most cliches are grounded in some reality, right? So we're having the Mag 7, and this reiterates, and I'll answer your question. This reiterates a topic we've discussed many times, is that when you get that long-awaited rotation between the US and the rest of the world, can that happen in a rising market? Or are the Mag 7 so big, right, at a third of the market cap, that if they are the ones getting rotated out of, which by definition would probably be the case, then will they drag the market down with it? And that the latter is, I think, the conclusion that I always drew. And it's sort of playing out, because the Mag 7 right now are down 4%. S&P 500 equal weighted index is down 0.35%, but the S&P cap weighted is down 1.8%. So no matter how well the little guys do, if the big guys come down, they're going to drag the index down. And this is why active management strategies, I think, make so much sense, because at least you have a chance to navigate that index effect. But to answer your question, let's go to slide 11. This is the MSCI Europe Index. So what obviously has happened, and everyone knows this, is that you know um, we had this moment where when Trump basically threw Zelensky under the bus, and with it the rest of NATO. Uh, Europe just realized that they have an existential threat on their hands. They need to defend themselves without the help of the US, which has always been there, as the big brother, right? The US as the global cop doing the right thing, even if it didn't benefit them, like, that nobleness that seems to have disappeared now. And so Germany, which then very shortly after that had an election which leaned more towards the right, is now doing a major fiscal impulse, right? They need to get defense spending to 5%. They need to invest in infrastructure. They have all these rules in Germany. You can't have more debt to GDP than this. So now they're talking about pan-euro defense bonds. Interest rates are rising. The euro is rising as a result, which I think is fine. But all of a sudden, there's an urgency to grow. And you see this in the MSCI Europe Index, it's right there. So all of a sudden you have the catalyst, right? You always need a catalyst, like a valuation difference alone is not going to do it because valuations are what they are. They're generally justified because the markets are very efficient in looking at earnings estimates and payout ratios. But when you get that catalyst that might cause an inflection in the relative earnings, then you get it. And if we go to slide 16, you can start to see that manifest, right? So these things don't work without a catalyst in terms of relative earnings. But if you look at the chart, and you gotta look closely, the blue squiggles is the S&P 500 earnings estimates by calendar year. And the pink squiggles are those for the MSCI EFA index, so non-US developed. And I mean, again, you have to kind of squint, but you can see them start to hook up a little bit. And if you look at the relative performance, the black line between the US and EFA, you can see a stunning reversal there just in the last couple of weeks. So that's why I'm saying the markets will always reprice faster than we can act. And that's why, you have to kind of make your bed and either be there too early, but have the benefits when it happens, or be there too late and miss it. And then again, there's no free lunch there. But you asked about China. So EM is a very bifurcated index, of course, right? So in recent years, and I've got where's my EM chart? Hold on.
While you're looking for
Slide 17.
got
So
it.
so EM has been very bifurcated, right? So India has been the big winner, right? And India is kind of like the Mag 7. These are large growth
So
stocks.
interesting you say that. That
Yeah,
makes
yeah.
sense. On the global stage, India's been
Yeah,
expensive
but
and
they're expensive, long duration growth stocks, and they are down just like the Mag 7 are because it's a growth to value play, right? And in this case, a growth to deep value play. And so if you look at this chart, this is the EM index with China and excluding China. So excluding China is the kind of the blue purple, and the overall index is the black. And you can see the difference there. So China, of course, has been the laggard. We know the story. You had these kind of, top-down policy decisions that were not very friendly to the free market. You have the overhang of the property bubble and all that stuff. But China was trading at a 9 multiple at the bottom. And then you started to see these little drips and drabs of policy changes. And of course, the last one was Xi Jinping in a room together with Jack Ma, the founder of Alibaba. And
right.
there's no way that that was a coincidence because when Trump got inaugurated, he had all the tech bros in the room with him as well. So again, just like in Germany, there's sort of a call to action here, saying like we gotta move this along. And I think so. China and Europe are kind of the winners here, and those also have been very very cheap. I mean, Europe was trading at a 13 PE, the U.S. at a 22 PE. So you got the catalyst of earnings, and then the valuation is the amplifier, right? Like if there's a big valuation gap, it just tosses gasoline on whatever was already going to happen anyway.
That's so interesting putting it that way. And then there's the discussion because you have seen Europe actually on a tear for all the reasons you just described. Now that you've got Germany, for instance, committing to make these changes, is this a bit of buy the rumor, sell the news? Like the news is out now, we know what they're going to do. I'm just curious if you think Europe has run its run its course?
Um, well, it's a really good question. And if we go back to slide 16, you can see how long the US exceptionalism trade was in place. It really has been in place since 2014. The Mag 7 have been, or the Nifty 50 have been in force since 2014. And so if this is just a small correction in a long-term trend, you
Right.
can argue if you look way at the top right in that sort of black line squiggle, you could argue that we've already done it. Like it is buy the rumor, sell the news, and that we've gone from above the trend line to below. But if this is a larger retracement of this, 10, 11-year trend line, you can argue that there's a lot more to come. And so that then you get into the weeds of, will Trump backtrack, if the market starts to go down? Supposedly, he doesn't look at the stock market anymore. He said that last week. It's hard to believe because that was his favorite barometer in the first administration. But now they're looking at 10-year yields, and 10-year yields are pretty well behaved because they know they have a lot of debt to finance. But you know, he could backtrack at any time with these tariffs. He already did, right? I mean, the Canada tariffs are now postponed till April 2nd or 4th or whatever. Um, and, Europe could run into trouble in terms of how do you fund this when you have already high debt levels, you have large entitlements, you have this North versus South dynamic where the Germans think the South is too lazy, they don't need more money, and like you get that whole kind of dynamic that harkens back to the Eurozone debt crisis. But this is something that's pretty existential. So if they can get their act together and issue pan-European defense bonds, then you would get some inkling of a fiscal union, which Europe has never had, right? They've had a common monetary system. So that was always the criticism against the
Right.
European
Yeah.
experiment. Like, how can you have a common monetary policy, but this disparate fiscal policy? Maybe if this brings the fiscal side a little closer together, maybe that can unleash some animal spirits there. But again, Europe is a strange animal. I'm Dutch, so we'll see where it goes. But I would be looking at the PE differentials here and the earnings squiggles. The earnings have to come through, or it really is just a trade.
Right. Yeah, interesting. Over the weekend, we heard even the president pressed on whether there could or might be a recession. He didn't discount it. I mean, the president says a lot of different things, so it's hard to know, to put it all in perspective. But if the U.S. were to go into a recession for some short-term reasons, or maybe longer term, does that not drag down the world economy? I mean, it would be great if Europe would be a place to hide in a U.S. recession, but I mean, can you draw that line?
Yeah, that's a really good question. And let me bring up the dollar on slide 19. It doesn't have to, because these are very obviously unusual times, right? So the economy here was slowing a little bit already, which is why the Fed was able to give back a few rate hikes. And of course, inflation has been sticky at 3%, but at least, it's better than 9%. But then you get the Doge chainsaw, right? And people really getting laid off. And anecdotally, I hear from people I know in Washington or people that I know who have been to Washington that people who work for the federal government are like scared to death, like about losing their jobs. And so we're watching the jobless claims and the unemployment reports for signs of that, but it seems to be happening. And that doesn't mean that a lasting recession will follow. But if fewer people are working, it's that's going to affect economic growth. And then, of course, you have the tariffs, which could decrease U.S. growth by, let's say, 0.5%. Again, not necessarily a difference between expansion and recession. Of course, for the trading partners like Canada and Mexico, it could be 10 times that much, right? It's a much bigger thing. And now we have, of course, the potential for a government shutdown. And shutdowns generally are nothing burgers. I get these questions over here on the U.S. side every time there's a fiscal cliff and a debt ceiling thing and a potential shutdown. And I always say, it's theatrics. It's an opportunity for politicians to make headlines. but generally speaking, if the money's already been spent by Congress, like it's like you just got to pay the bills. But in this particular case where disruption and government efficiency is a central theme to the Trump administration, I could see them being okay with letting this drag out, right? And that means that people have to go to work without getting paid. Minor things like national parks have to close. I mean, these are not the end of the world because they will reopen at some point. But if a shutdown drags on long enough and enough
Tax
people are,
season or something, if you know you
well,
can pay your tax, the
like,
government doesn't get the
yeah,
tax.
I mean, the IRS workers are federal workers, right? So people would not be getting their tax refunds if it lasts past mid-April. So you can see this maybe on its own wouldn't create a recession, but you add this to the tariffs and you add this to the Doge thing, and already kind of a mild slowdown at the beginning. And you can see how the market has gone from pricing in animal spirits to now pricing in maybe not a slam dunk recession, but at least the possibility of one. And again, if it's about Doge and the shutdown, it would be kind of technical and temporary. But a recession is a recession, and that's something that was very far away from the radar screen just a few months ago. And you're seeing it here in the dollar, right? The dollar is really coming down because all of a sudden it's like, wow, maybe we're getting the opposite of animal spirits now. And this is like, it's part and parcel of this administration. It's like move fast, break things, and you worry that if there are not enough adults in the room because everyone is speaking from the same playbook, that they can break things a little bit too much and then have to try to piece them back together. And that, I think, is kind of the roller coaster ride that everyone has signed on for. They may not have signed on for it, but that everyone is sort of bracing for here.
Okay, that's fascinating and such good context to sort of put it in. So the S&P and small caps drawdowns are equally reminiscent. Are they equally reminiscent of equities and bond correlations that we saw? Could you compare these scenarios?
That's a great question. So let's go to slide 6 first, Mag 7. And again, they're down 4.5% today. So they will be down more than 20% from the high. We've seen that before. It's not the necessarily end of the world. If we go to slide 10, you see the same thing, but on a weekly longer term chart, and you can see, that rising trend line is still intact. We had a large correction just last summer, right? When that yen carry trade was unwound, and they happen. And if you look back to the dot-com era, which is not in this chart, but you look at the poster child of that era, which was Cisco Systems, it had dozens of 20, 30% corrections on their way to new all-time highs. So I don't want to read too much into this. Positioning gets crowded. Everyone was on board. These were the no-brainer stocks. You don't have to ask any questions because the stocks go up, but they're clearly in a drawdown mode right now. And then we go to small caps on slide 8, and they're down about the same amount, right? The Russell, well, it's down 1% today, which is less than the Mag 7. But what's interesting is that this is a different scenario, with the caveat that this is only a few weeks, been going on for a few weeks. But in 2000, when the dot-com bubble burst, again, not to make a parallel between then and now, uh, but like the Nifty 50, imploded, and everything else did extremely well, right? So value, small caps, and that's like not, we're seeing something different. You're seeing the small caps get punished and the mega caps get punished. And the small caps, I think that one is kind of easy to see here because tariffs are going to hurt maybe companies that are smaller, that have fewer substitutions for whatever they're importing. And so it's an interesting dynamic, but the S&P equal weighted is sort of in the middle there and doing its own thing. So I'm sure when I start looking at the correlations, which is what the question was about, at the end of the week, we'll see the correlation between the S&P equal weighted and kind of the two bookends go down. And I think that's, financials are kind of part of that because they're more represented in that style. and the financials are benefiting from a steepening yield curve, and deregulation. So maybe they're one of the safe spots here.
They might be able to sort of come through it with other things working out for them. So how much have the markets priced in now the reality of reciprocal tariffs? So right back to tariffs, which is kind of what we're sleeping and breathing. And the 25% tariffs being maintained. So this is, what's been launched on Canada, then taken off, but the idea of reciprocal tariffs. To what extent is this story priced in? I mean, arguably that's a big reason for the market volatility
Yeah,
seeing right
it,
now.
it's a great question, and that actually would be is a good project to try to get a real-time gauge of how much is priced in. I mean, ultimately, it would reflect valuation. So if we go to slide 15, we can see that valuations are coming down in the US, right? The price to free cash flow ratio for the cap weighted index is down 5 points, and the equal weighted is down 4 points. So it is happening. It is getting repriced. But the big question is, is this are we in the midst or the beginning of an actual long-lasting trade war? Or knowing the way the White House operates, will they at any time say, "Oh, never mind, just kidding," And I think it's something that nobody really knows. And so we would have to look for signs where the market is very oversold technically, sentiment wise, very oversold. And actually, if you look at I don't have the chart, but the American Association of Investors, Individual Investors, the AAII, showed the most number of bears last week that we've seen in many, many years. It's one of the highest readings ever recorded. And
Since the
so
Gulf
I think
War, I think it was, wasn't it? Since the Gulf
yes. And
War.
so I think to answer the question, you look for hard scientific signs of PEs, earnings estimates, whether they're rolling over or not. And part of it is more anecdotal, right? So how far below or above your trend line are you? What is sentiment saying? What does the breadth number say? Only 50% of stocks are above their 200-day moving average right now. But you look at the earnings squiggles, right? Slide 13, for the Mag 7, they're still rising. And in the next chart for the 493 that are not the Mag 7. They're not rising, but that's fairly normal. So if we go one slide to slide 14, um, that's a fairly normal backdrop as well. So, and then if we go to slide 12, and we've shown this slide many times, the earnings versus valuation backdrop. I mean, the earnings side so far is good, but we would be looking at the tea leaves, sort of, are the revisions going up or down, and things like that. How much of a GDP shock is being priced in? And
Yeah.
unfortunately, we have the tariffs, of course, but we also have the Doge phenomenon, and we now have the shutdown potentially. And so there is not a single thing we can point to because we don't know how much to attribute whatever we're seeing on the charts to the different things.
So that's fascinating. And it leads to, there's a question here about gold, why the price is going down. And I might just ask you to sort of within that, take a look at the story of the dollar being down and what that means for commodities. Maybe that'll be our final question. But yeah, I'll look at sort of
Yeah,
commodities
yeah.
broadly.
So let's go to slide 3. This is kind of a fun chart. But I've been bullish on gold, and with the dollar now weaker and likely more infrastructure and defense spending, that should boost commodities as well. And so this is the kind of efficient frontier from 2020 to now, and you see Bitcoin way in the upper right, the Mag 7 is way up there, and then you see commodities and gold, holding up pretty well. Of course, bonds have been at the bottom. And so I think, there's a good bullish story to tell here. And actually, if we go to slide 2, this is my leaderboard quilt on a 3-month rolling return basis. So that's slide 2. You can see how the leaderboard has switched, and you have to really squint
Yeah.
at this. But at the bottom, at the top is China, gold, commodities, Europe. I mean, we haven't seen that in a long time. And at the bottom is, Bitcoin, S&P, and the Mag 7. So it's a whole different ball game. And And if we just go to one last time to slide 17, I know we're running out of time, but back to that EM chart, a very important indicator to follow is the bottom one, which is the CRB raw industrial. So that's a commodity index that has no futures trading on it. And so it is like a pure spot index. And you can see how it sort of cycles. And when it does, EM tends to go along. And I wouldn't say this is a massive uptrend but you can see kind of a rounding bottom in that CRB raw industrials, and that is a sign that companies and countries are spending on raw materials again, and that's part of this sort of global reflation story that we've been talking about.
This is fascinating. This is like the most interesting half hour. Thank you, Jurrien Timmer, for joining us and taking us through this journey. Really appreciate your time.
Welcome. Thank you.
Have a good week.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.